Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LFI Levered Lines. My name is Kerstin Kubanek. I'm the senior reporter at LFI, and with me today is John Anderson, who is partner at law firm Goodwin. Thank you for joining me.
Thanks a lot, Kerstin. As you say, I'm a partner at Goodwin, focusing on private credit fund formation and structuring. We advise a broad range of sponsors, from large established credit platforms to newer strategies and managers across fundraising, liquidity solutions, cross-border reg and structuring issues. And so a lot of what we see sits at the intersection of investor constraints, fund architecture, and the evolving credit markets, which is why this is a kind of great forum to be involved with.
Yes, and let's just jump right in there while I have you here. In the last few years, we saw a massive inflow of insurance capital into the private credit space, right? Worldwide, basically. But with the latest hiccups in the market, it seems that investors kind of try to flee, which is understandable. But do you think that insurance companies and the insurance capital will basically outflow now with the current situation?
So from what we're seeing, I don't think we're seeing kind of insurers or insurance capital kind of pulling back from private markets, or really from private credit. We see them changing their access point to better fit their kind of capital efficiency and ratings frameworks. In terms of the market volatility and kind of recent events and so forth, I think from insurance capital perspective, I'm not seeing it as reducing their appetite for private credit, but maybe more prioritizing higher quality, near investment grade or investment grade balance sheet exposure. But the way that they're getting it is not by sort of going out and buying investment grade bonds in this private credit market. It's about how they're accessing it. So they're accessing it through structured access vehicles such as rated note feeders, collateralized fund obligation type structures. If this is done right, that can translate into kind of a capital efficient tranche with an investment grade rated tranche that's looking down into and underpinned by private credit assets.
That's interesting to hear. What we also saw recently, or fairly recently, it's an increase in private credit continuation vehicles, especially over here in Europe, right? It's not quite that common. We see a lot of continuation funds in the private equity space, but in the private credit space, it's relatively new. Why do we see an increase in the moment? Some people think it's just because, some of the fund managers try to move some of their assets from that do not do that well from one fund to the next one. Is that really the case? Is that simple?
I have been historically a cynic for certain parts of kind of like secondary processes, concerned about some of the themes you identify, the kind of warehouses for bad assets or something like that. But really, actually, sort of having watched this market evolve and watching it evolve alongside the credit secondaries market in particular, more broadly, I don't really think that's the case. I think it's like private equity secondaries, credit continuation vehicles, and just credit secondaries. It's in general, it's a becoming a mainstream normalized liquidity and duration management tool for private credit specifically. So in line with the increase in the overall credit secondaries market, there's been an increasing number of large-sized GP-led credit secondary transactions. And in many, if not most of these cases, they are underpinned by, of course, what are described by the participants, but I think, a fair statement, like seasoned senior, like high quality debt portfolios. And so that's interesting because what that signals is that you interested kind of willing buyer, willing sellers that want to kind of realign their duration risk and maturity risk and liquidity risk. And so like this is kind of facilitating people that maybe have shifting preferences in that regard. Some of that may be market and macro driven. So some of the liquidity pressure, but what's interesting to me is it's not necessarily driven by just like fundamental stress in portfolios and a concept of putting all the stressed assets into these transactions. Sure, there's still stress, like overall, we've seen an increase in amend and extend and in PIK and so forth, but that's sort of there already. And it's not clear that these vehicles are not just sort of a dumping ground for bad assets or something like that. Really, they are designed to, through a particular structure, meet liquidity requirements and meet kind of duration management issues that exist, preserving the assets as they go. So I've become more of a believer when I've sort of seen these, like coming around over the past couple of years.
But when you say liquidity pressure, I mean, there is liquidity pressure that basically derives from investors, needing the liquidity out of their investments. But there's also liquidity pressure in the sense of GPs needing a lot more liquidity to repair or make some investments, etc. So what are we talking about here, do you think?
So I think there's been pressure on GPs to make distributions to investors. So there's that sort of form of liquidity. I guess there's also a need for having cash flow to put into new investments and sort of continue the business. I think here this is more about providing investor liquidity options where you have assets that would benefit from being repackaged or held longer than the time frame of the kind of funds in which they sit. And so kind of having a disciplined structure that offers new pricing and assessment of those assets kind of for the parties concerned and choices to be made about rolling or exiting and so forth. Kind of in my mind, it creates a more transparent process and governance around how those assets can deliver the best value, taking into account the needs of the investors and the other counterparties, the new entrants going forward.
And what type of investments do we find in those continuation vehicles?
So for credit CVs, what we've been seeing is really it's a set of consistent with the investment strategy for the particular credit funds. And we're seeing senior secured loans like making up kind of predominant part of the package. Obviously, as the kind of market expands and investment strategies that include, more subordinated capital maybe are picked up, it's not going to always be like just a full mix of senior secured loans in the portfolio. I think that what the difference with, say, a PE CV, a lot of times a PE CV is to take out particular, assets. They have great qualities. They may need some more time. There again, it's not a theme of this is a bad asset. It's this asset could do very well. It needs a repackaging in some form. I think by contrast with the credit CVs, this is more, we have a high quality portfolio that we want, that would benefit from continuing. And there's some people that would like to get on board to carry that through. And existing investors, this is an opportunity for, you to either kind of continue in the journey or potentially like have some monetization event now, if that's kind of the requirements for your liquidity profile, but senior secured.
Okay, that's interesting. Also, in the last few years, we've seen quite a lot of NAV financing, and not only private equity, but also private credit related financing. What's the status now given that the market is kind of volatile or more volatile than we are used to? What happens with those NAV facilities? Do we still see a lot more NAV financing coming to the market? Is that finally the tool that everybody praised 2 years ago as the repair tool? What do you think?
So, I mean, well, it is a flexible toolkit, and first have to what do we mean when we say NAV? There's that sort of definitional aspect to run through. It's continued to expand. It's delivering loans. It's delivered in loan format. It's delivered through preferred equity. It's used across the fund stack. It's portfolio level leverage. It's single asset financings, asset strip financings. It's used in credit CVs or other CVs potentially to enhance, for additional leverage on that transaction. And it's used in GP level solutions for GP financing for the commit and otherwise. So it's kind of the ways that everything we call NAV financing are intersecting with and touching this private market is just kind of really expanded, very interesting. Where it's used as portfolio leverage, I guess that's kind of in some way, shape, or form, that's kind of where investors are probably most focused. I think that it still continues to be, you don't lever everything, but you match the tools to the investor constraints and to the market. It still continues to be the case that there's some investors that want a levered strategy, particularly in credit. Some want a levered strategy, and then others, often those might be European institutional investors, just kind of historically, are not so interested in a levered strategy. So for credit fund structures in particular, we still see routinely flexibility introduced into the structure, the offering of levered and unlevered sleeves in order to kind of appeal to the risk profile and return profile for the investor base or the different parts of the investor base that the manager's aiming for. In the EU, there of course are the AIFMD leverage limits. Like for closed-end funds, our experience has been with sponsors that they don't really see those as kind of huge constraints in and of themselves. It's more, but they are there and they do need to be managed. It's more about how much the advance rate the lender is going to give you, and whether your investors had some guardrails about how much leverage they were willing to invest in a fund if it took on that level of leverage. I think it remains I think it's an important part of kind of return enhancement for many portfolios where there's a constituent part of the investor base that doesn't want it. Then for credit funds in particular, there's flexibility offered to kind of have a non-levered sleeve. But I don't see it going away. The cure for all ills or the fix-all for all problems kind of mentality, I think you were kind of referencing from a couple of years back. I'm not sure it's that, but I also think it's an important part of the toolkit. And leverage and structures, whether it's at the portfolio level or down in the assets and so forth, this still and including the leverage that the credit funds are providing to the downstream companies that they're lending to, kind of overall leverage and structures is still a key element of underwrites and kind of thinking about overall portfolio construction and how that plays into current events, macroeconomic conditions. That is something that sponsors that will still continue to focus carefully on as they manage their portfolios.
Yeah, makes sense. And do you expect the latest discussions around AI to kind of reshape the whole private credit industry in some way or another?
I mean, first of all, it is just sort of staggering the kind of the pace of expansion of AI technology kind of into just different areas of business and practice, including legal practice. In terms of the credit markets, I see sort of two distinct stories that are coming through. One is not dissimilar to kind of some ways that law firms are starting to use AI. There's an operational layer already being used in credit platforms for monitoring, for portfolio, like kind of like assessing, helping to assess data, to enhance the robustness of document review, dealing with all of the paperwork, like covenant tracking, notices and compliance certificates, and just sort of generally being on top of the portfolio. I think this is kind of like, this is going to turbocharge like the ability to do that like efficiently, and probably like with less stones unturned, it would be the hope and belief, right? But in a managed way where you're using it, AI as sort of a tool. So that's just coming along, and that doesn't surprise me, because like in the private credit like fund market, it like a theme that is played out over the last like decade has been increasingly for firms to say, we want to take insight from, we want to collect all of our data, and we want to analyze it, and we want to make data-driven decisions, like good data-driven decisions about our business generally. Like, and so that would include the portfolio and just kind of anything else that you can kind of aggregate and analyze data on. And AI like is very good at doing things like that quickly, to kind of put you in a position to assess more quickly. And so for that part of it, I think it's just a no-brainer, and I think that's just going to continue that theme. On the other story is, what about all the software companies kind of theme? I don't think it's kind of AI is the winner, and like other types of software offerings and strategy is the loser. But I think what it leads to is just something that's true of every market segment that undergoes any kind of disruption, which is that the underwriting is going to be more focused and more conservative as the kind of new developments are digested. In the same way that like not too many years back, like SaaS was like offerings and companies were like the disruptor, and you know, and a lot of concern around platforms that had a lot of inbuilt hardware and the like on a kind of local installation. Like the concern, oh, is this all going to become completely irrelevant? I think it's just a new factor that will drive like and be a key factor in underwriting, but doesn't just sort of necessarily lead to every like kind of a blanket statement that every software company is just going to be a bad proposition. So I think that AI is not kind of rewriting credit outcomes overnight. It improves monitoring, and it will probably push more disciplined underwriting, including for segments that may be kind of challenged by AI.
So in other words, we will see the data transparency that everybody's been missing in the private credit space for such a long time.
I think it would help facilitate it. It's interesting you make that point, because I think when I think about like insurance capital in particular, like in terms of like how when they're kind of the way that they're structuring their investments into private credit, we're already seeing more transparency, kind of more discipline, more connection with the rating agencies and the methodology for the kind of particular strips that make these make up these rated access points. And I think while that is a securitization-like type structure that's repackaging underlying loans, it's forcing to some degree kind of underwriting discipline. What is the quality of the portfolio? Like forcing you to kind of think through the portfolio risk as it leads up into these instruments. So I think in some sense that is like actually working to increase transparency, at least from the perspective of those investors.
Thank you very much for this lovely conversation. Thank you, John.
Yeah, absolutely. We continue to see a lot of flexibility in structuring as a competitive advantage, and kind of like governance and structuring are going to matter as much as underwriting of the underlying investments, kind of in the world that we're looking at now.
Thank you very much. Thank you.
Thanks for having me, Kerstin.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.